Hello, everyone, and welcome back to another episode. I'm your host, a Millennial Investor, and today I was looking over my portfolio and I realized a lot of the companies that I currently have are trading at much lower valuations than a lot of the hot stocks out there, the ones that are high flyers that are growing rapidly. But a lot of companies that I own are very high yield dividend paying stocks. So, what I decided to do is I wanted to take my top 5 dividend payers, specifically focusing on ones that are pretty high yield and at a really steep discount right now, and go over them and tell you why I think they're really good buys. Because if we go to the research tab here and we click stocks and we sort by market cap, I want to go ahead and show you the dividend yield of our top companies. Apple, a 0.6%, Microsoft, 0.8%, Amazon, 0, Google, 0, Tesla, 0, Facebook, 0. The list goes on and on. Most of these companies either have no dividend or very small dividend yields. And the companies I'm about to show you all have it anywhere from 3 to an 8% dividend yield. So I'm going to go over these 5 companies in just a moment, but before we do that, if you're not familiar with me, my name is Jordan. I'm the Millennial Investor. I track my annual and monthly dividend income through these 2 charts right here. I update these every single month, and we did just update it for the end of January, and we are now up to $315 worth of annual dividend income, and we received $26 last month worth of dividend income last month. And then my portfolio value and monthly YouTube income is also tracked right here. We update these every single month as well, and these are my investing goals and stock market prediction for 2021. And as you see these goals, one of them is 100 referrals to M1 Finance. And it seems to me like we're probably going to have to increase that goal because it's February and we've almost reached that point. With the new promotion that M1 Finance has going on, I've had so many of you guys sign up, tell me how much you love the platform. And if you download this link and deposit $100 to the platform, you get $30 just for getting signed up. Usually it's a $10 bill. Well, right now it's 30. We've had 86 people sign up, so I'm thinking about increasing that goal to 150. Actually, let's probably just go ahead and do that right now. Let's go ahead and increase that goal to 150 because I think that 100 referrals just isn't enough for what we're doing. But anyways, guys, if you're interested in getting signed up, that's down there below. And if you want to see my entire portfolio, not just the 5 that I'm about to show, this is going to be shown in the video, but there's also a link down below if you want to see it yourself. But let's go ahead and get started with number 1. We're going to be looking at Altria. Altria is the highest yielding stock in my portfolio, and I just made a video about this company recently. I currently own the company about 6.8 shares worth at $39.83, and it's currently trading about $43 a share. Now, they did raise that dividend in 2020, and they're looking to raise it again here in 2021. And if you take that dividend payment, let me go ahead and get my calculator here. Let me get it pulled up. So right now, they pay 86 cents every single quarter. So on an annual basis, they'll pay $3.44. So if you take 3.44 and divide by the number it's trading at right now, 43.31, as of today, it currently yields 7.94%. It has a dividend that is almost an 8% yielder, a couple pennies off. Now, if you buy this company and it's able to maintain that dividend, regardless of where the share price goes, this company will be paying out an 8% dividend yield just to own it. So if you're able to buy this company, hold on to that investment, they're able to raise that dividend over time, and this company's share price gradually goes up over the next 10 years, you're looking at some pretty impressive returns. Now, like I said, I did just make a YouTube video about this company just recently, but I wanted to go over some of the basics about this company, why I think they're going to be successful in the long term. But before I go over their 10-year strategy, I wanted to go over some of the companies that they own. They obviously have their main brand, Altria, and some of the brands that they own behind that is Philip Morris USA, U.S. Smokeless Tobacco Company, John Middleton, an Altria company, STE Mitchell, Wine Estates. I believe that makes up a small portion of their revenue. I think it's only like 2 or 3%. And then they also have Philip Morris Capital Corporation. They have their strategic investments, and this is what's really important here. Their strategic investments in their joint ventures, specifically these two right here. They have their strategic investments inside of Anheuser-Busch, an alcoholic beverage company, and then they have Juul Labs and Kronos. They also have a joint venture with Helix Innovations. Now, these two are what I want to focus on, Kronos and AB InBev. Now, Juul has not worked out lately, and I know that they've had a lot of hatred towards Juul, and the reason why this company's went down so far in share price is mostly because of that Juul investment. Now, what I wanted to go ahead and do is I wanted to pull up Anheuser-Busch. Now, this company has been hit very hard from the recession, and this company has previously paid out lots of cash flows to its shareholders. Well, if you're an owner in this company, it will pay out cash flows just like Altria does. Now, one of the beauties of this is that guess who one of its largest shareholders is? You're looking at Altria. Now, when you look at Anheuser-Busch, it's not very pretty. Their 5-year chart is down very hard, mostly due to the recession in 2020. They're kind of revamping their entire business. But in the meantime, they still do the same thing that Altria does. They create an incredible amount of cash flows. And if this company is able to maintain paying dividends every single year like they have for the last couple of decades, then Altria is going to benefit from receiving lots of cash flows from that investment, and that is going to help them fund operations even more. Now, they have their second investment. They have Juul, and this is not a public company, so we can't see their stock chart, but Juul is a company that has been hit very hard from all the strict regulations. And the good news about this is that even though they have went down significantly in value from where they originally purchased Juul at, I think the worst is behind them, because Altria has been hit so hard in share price from this Juul investment that it pretty much now has nowhere to go but up. Their Juul investment has had so many bad regulations come towards it, and even if this thing is a bust, then this company is still going to be okay. Altria still has the mass majority of their revenues from other sources outside of Juul, but if they're able to keep that investment in Juul, and if it does indeed turn around, it's just a bit of a wild card for Altria. I'm still glad that they have this ownership in Juul. Now, third, they have their Kronos stake. Now, if their products are legalized in the United States, then Altria is going to have massive success. If we go ahead and look at the year chart here, you see that this company was trading about $5, $6 a share. Well, today it's trading at 13, hitting a new all-time high right now. And remember that Altria owns a huge stake in this company. And this is very good for Altria because as their investment gets more valuable in Kronos, as this company is able to achieve legalization in the States and basically just expand their business and get to a profitability stage, then guess what? You're looking at it. Altria is once again going to have a very valuable investment. Now, the good news is I could see a scenario where a lot of these companies that sell the products that they sell, like Kronos selling the MJ, once we start talking about this a decade out from now, when these companies start to have brand recognition and they start selling steadily the products that they're trying to sell, I think that eventually some of these companies will also begin to have dividend payments. I think that some of these companies like Kronos, while it may be a very long ways away, maybe at least a decade out, they will eventually probably start returning cash to shareholders. And by then, by that point, I'm sure at the point that which Altria bought them at, once again, more cash flows for the company. And even if I'm wrong, even if they never have a dividend payment, this company will eventually go up in value from its profitability. And eventually, once the space gets legalized, this company will probably be a lot more valuable than what it's at today. Now, if we keep on going further and we close out this tab of our company's tab, I wanted to look at their 10-year vision. Now, before I go over the sections here and what they had to write, I wanted to show you something. I'm always focused on not where a company has been, but where a company is going to be. And so when they're focused on a 10-year vision, they have some of their tabs right here, and I won't read them one by one. I'll let you pause the video if you want to read them yourself. But basically, this company is not focused on tomorrow. It's not focused on the next day. It's not focused on 2022. It's looking a decade plus out. And their new CEO is focused on the long term as well. And that's what provides me as a shareholder a lot of comfort, a lot of reliability, and that's why I'm betting on Altria. While it does have a massive 8% yield, I think they're able to maintain that dividend payment, and I think it's going to steadily increase my value as a shareholder. Next up, we have one that I've just added to the portfolio. It's one that I'm very excited about. I think right now in my entire 28 stocks in my portfolio, it's arguably the most undervalued in the entire portfolio. I've bumped it up from 0%, not even being in my portfolio, all the way up to 4% of my entire net worth. And I think that right now, Lockheed Martin offers a lot of value to shareholders. Right now, they just increased that dividend about 10%, their last dividend payment. And if we pull up my calculator again here, $2.6 times that by 4, they pay out $10.40 a year to shareholders. So take $10.40, divide by the share price number, 341.15, and as of right now, they currently have a 3.04% dividend yield, so just over 3%. But while this company does have a reasonably good yield at 3%, which is pretty good in today's market, what's really attractive here is the share price opportunity. You can see how this company has a large steady uptrend in share price, and that is because this company is still growing massively. I want to go ahead and scroll through the products while I talk to you about Lockheed Martin. It would take a million bajillion years to go over all the products that this company has to offer, but I'm just going to scroll through them while I talk to you about Lockheed Martin. Lockheed Martin was able to increase its revenues and increase its profits throughout the Great Recession. It was able to increase its revenues, increase its profits throughout the 2020 pandemic. This company is not cyclical whatsoever. Basically, their entire funding is relied off of the government spending budget for the United States military, and they produce, I believe it's roughly around 70% of all aircraft for the U.S. Air Force. And while this company has lots of other products to offer as well, if you think that's impressive, what's really impressive about this company is that no matter where the spending for the defense budget goes over the next 10 years, this company currently, as of today, has over $150 billion. I'm going to say it again. They have over $150 billion worth of backlog. This company has revenue stacked up so far into the future that even if the spending budget were to go down significantly, this company would be just fine. Not to mention their new CEO, which I'm a huge fan of, Jim Tastelet. I think that he is well prepared for his new position. He is an excellent choice. He's a young, thriving guy, and I think that the way he is focused on the future as well, the same way that Altria is focused on the next decade, that new guy Jim has the same outlook as well. And he's even spoken about the shrinking defense budget. If that were to happen, he's went out and said that even a dramatic downturn would still leave this company doing just fine because of the amount of profitability, the amount of cash flows, and the massive amount of backlog that this company has. So pretty much, I couldn't see a scenario where Lockheed Martin just goes bankrupt overnight. And even if they were to have some massive downturn, do you really think that the U.S. government would just let this company go away? Do you really think that the United States military is just going to say, okay, we don't need any of their products anymore, we'll just go ahead and let them go? I don't think that's going to happen. The amount of patents and the amount of awesome products that this company produces for our United States military, it's uncomparable to any other company out there. So their company is a need-based company for our country. And I couldn't see a scenario where this company doesn't continue to increase in share price, increase shareholder value, and that's why you've seen that dividend pretty much double just in the last 5 years. You're usually looking at a company that raises its dividend in the double digits. While it does have a pretty good steady yield of 3+%, it only pays out less than half of its profits. When you look at that dividend yield and see that it's about 3%, it has a payout ratio that is under 50%. So not only could this company maintain its dividend yield of 3% plus, it could double that dividend payment tomorrow and still afford to reinvest back into its business. It could double up to a 6% dividend yielding stock tomorrow and still afford to make those dividend payments. So that's why I'm bullish on this company. I really like where it's going, and I've considered bumping it up in my portfolio even more because there's been a lot of negativity about it, and this is, for me as a shareholder, offers a lot of opportunity. I was really attracted into buying the stock in the high 300s at 380, 390. Now it's getting to the mid 300s at about $340, $330 a share. It's starting to get real attractive. If this thing dips under 300, I will begin buying the stock like crazy. If it gets to $300 a share or into the 200s, it'll probably be one of my largest positions. So I'm definitely going to be betting big on Lockheed Martin right there. Next up, we have one that I've talked about a lot. And I mean, since I've started this channel, I've talked about a lot in my portfolio and on the YouTube channel. It is one of my largest positions. It is currently my third largest position, and I've considered bumping it up even more. It is currently making up about 7% of my entire portfolio, and it is one of the largest yielding stocks in my portfolio. And it's one of the only companies that I can find that has a 6+% dividend yield that is completely safe, at almost no risk of cutting it any time in 2021. When we look at this company, this is a real estate investment trust. And so what they do is they buy properties, they then rent those properties out for more than what they paid for. They receive cash every single month. They have cash flows from those properties, and then take those cash flows, those profits, and do two things. They pay it out to you, the shareholder, and then they buy more properties to do the same thing over and over and over again. And by the way, like I mentioned, in the same way that they get those cash flows, every year those properties will go up in value, and they will raise the rent on those same tenants. So they might only raise it 1%, 2% every single year, but if they're able to do that, you can see how that's pretty much all profit. No overhead, they're still doing the same thing they were last year, except now they're making more money to do the exact same thing for a property that they already own. Now, the type of investment criteria that they're looking for, they're looking at purchasing properties that look like some of these. These are some of the examples that it shows down here. And they're spread all around North America and around Europe, so they're geographically diversified. And speaking of diversification, they're in all different sectors, all different industries. And we'll talk about that in just a second. They have single tenant occupancies, and they're looking at purchasing properties anywhere from the $5 million to $500 million range. So very large purchases. These are not any kind of small standalone stores. You're looking at huge properties. They're spread out along the U.S., North America, and Europe, and they have property types that are industrial, warehouse, office, retail, and other specialized assets, including things like agricultural. They do rent out properties across all credit profiles, and what's really important here, this tab right here, is extremely important. Their lease term, typically 10 years plus. There's some of the leases that they have on here that are 10, 20, 30 years out into the futures. So this company is not focused on the short term. This is, like I said, this is something that I focus on companies. I don't care what the company does this year. I don't care what the company does next year. What is the long-term outlook? What is the 10-year outlook for this company? And this company has properties spread out among 1,200 different properties. They have $1.2 billion in base rent, and almost 99% of their properties has tenants being paid out to them every single month across 351 different customers. So it's not like they have all their revenue coming from one company where it's like, oh, if this customer goes away, that's 40% of our revenue. We're done for. No, no, no. This company does not have any massive amount all paid out to one tenant. It is all coming out across 351 different customers, and 99% of their properties had rent escalate last year. 99%, meaning they raised the rent to their tenants. And they're not going to move away because they need these properties and it is very important. And like I said earlier, I would wrap back around to this. While they are geographically diversified between the United States and Europe and as well as a little bit of other, they have lots of different property types, including industrial, warehouse, office, retail, self-storage, agricultural. And then they also have tenant industry diversification. I won't read all these, it'll take way too long to get through all of these, but from things like banking and hotel and leisure and beverage and food and grocery and cargo and wholesale and lots of other things as well, they are diversified between all industries. All industries. So like for example, you see right here where my mouse is hovering, 3.2% in hotel and leisure. That is something that got hit very, very hard in 2020. Now let's go ahead and say that that was 20% of the revenue. That would hit them very hard in the 2020 pandemic. But they're so spread out, they're so diversified, that even if this one sector were to turn down, they still have 97% of their other revenues coming from different sectors. So this is a company that is geographically diversified, has lots of different property types, and is in all industries. And they have currently 99% of their portfolio rented out to tenants, and they have 99% of those properties going up every single month. And when you take the current dividend payment, which by the way, this company raises its dividend every single quarter, very small amounts, it currently pays out 1.046, and if you time that by 4, they currently pay out $4.18.4. So if you take that 4.184 and divide by today's share price of 68.65, this currently has a dividend yield of 6.09. So over a 6% yielder, and to think that this company has actually increased revenues and profits since its peak in 2019, why is this company trading at such a discount? This is where I look for opportunities as a dividend growth investor, where this company is trading at 20-30% off its highs, but has more revenues and profits than it did in its peak back in late 2019. So WP Carey, a very large company I'm betting on, a massive amount of my portfolio, might even make up a larger percent here going into 2021, and I absolutely love this company, and it has also provides the most income out of all the companies in my portfolio. As you can see from this left-handed column right here, when you look at WP Carey, it is the largest payer of the bunch, currently paying me out $40 a year just in dividends alone. And if we keep on going further, I did just make a video about this company Verizon, so I won't make this too long, but basically when you look at Verizon, it is basically a boring old business, not a lot going on for them. They pretty much do the same thing over and over and over. And while this company doesn't have a lot of growth opportunity, while this company has not had a lot of share price growth, it does one thing great, absolutely incredible. And what it does is that it produces massive amounts of cash flows. Let's go ahead and look at this little bullet point right here, the second bullet point for the key financials of 2020. Net cash provided by operating activities was $42 billion. $42 billion is what this company was able to produce just from its telecom business. While this telecommunications company doesn't grow very rapidly, usually just 1 or 2% a year, its profitability is so high that they have so many opportunities to go into new areas or to increase value to shareholders through capex spending or increasing that dividend payment or share repurchases or whatever the case may be. Regardless, Verizon is one that I think has a steady dividend payment, and as of today, if you take their dividend payment of 0.6275, so let's take 0.6275, multiply times 4, so that's $2.51 a year is what it pays out, divide by today's share price of 54.75, as of today, it currently yields 4.58%. So over a 4.5% dividend yielder. Like I said, if you want to hear more about Verizon, I just made an entire video about them. And when you invest in a company like this, it is not going to be a high grower, but as a dividend growth investor, this is what you want to see. And then I want to go over one last company, and this is a company that has went down massively just in the past month, and it is now much more attractive. We're betting on a company that has a very strong legacy business. It has been around forever and ever and ever, and has been paying dividends for practically since the beginning of time, okay? This company is due for another dividend raise, I believe actually tomorrow. They should be announcing it. I believe so. And this company, Coca-Cola, you all know it, you all heard of it, and it won't take me too long to explain it, but I just wanted to show a couple quick things about Coca-Cola. They've had some revenue declines and some profitability declines in the last couple of years, and a lot of people are betting that this company just won't be what it used to. And while that might be the case, I'm going to say the exact opposite. I think that this company is currently hitting some hard times, and it's currently at a turnaround. Now, if I'm wrong, this company currently pays out a dividend of 41 cents, and like I said, they're due to raise that this week, so it'll actually be higher than that. But as of the time I'm filming this, they pay 41 cents a quarter, $1.64 a year. If you take that and divide that by the current share price of $49.79, that means that this company currently pays out a 3.29% dividend yield. And that's before the raise. Like I said, they should be raising it this week, so expect that to be a little bit higher, probably around 3.3, 3.4%. So if it has a massive dividend yield, a growing dividend payment, a steadily increasing share price, while it's been hit heavily right now in the past month or two, from $54 a share, 55, all the way down to 49, I think that this company is not getting the appreciation that it deserves. Its hot and cold beverage industry at retail value is currently being valued at 1.6 trillion and is split up between hot beverages, tea and coffee, NRTD cold, energy, hydration, juice, dairy and plant, and sparkling soft drinks. And if you want to see some of the important stats, I'm going to scroll through them here for Coca-Cola. This company is doing a lot better than a lot of people predict. And if you look at its developed markets and its developing and emerging markets, Coca-Cola, while it does have a good chunk of the market share, it still has a lot of opportunity to expand into other categories. While it has a lot of big brands like Sprite and Coca-Cola and Dasani Water, it has a lot of newer brands that it's expanding into to create more profitability and revenues for the company. Now, if we keep on going further, let's go to the last tab here. So what we have here is we have the developed markets, the North America example, and the developing and emerging markets, a Romania example. And I think it's really important to see a real world example because I don't know about you, but I've seen this firsthand in Walmart and Target and lots of other stores like that as well that sell Coca-Cola products. So when you have your traditional 12-ounce can, this has been the popular traditional can that everybody has bought for decades and decades on out. And now you have the new mini 7.5-ounce can. Now this does two things. The first one is that it attracts consumers for the new consumer trends that we have going on. Consumers typically want less sugar, they want less calories, and that is what offers the appeal to the new consumer base that we have today with the 7.5-ounce can versus the traditional 12-ounce can. Now, what's the beauty of this? What's so great about this? Not only will it increase revenues as people tend to spend more on these smaller cans than they do on the traditional cans, but the cool part is that the profitability on these smaller cans are actually better than the traditional 12-ounce. Next time you go to Walmart and you see these side by side, if you look at the dollar per ounce, what they're charging for the amount of fluid actually in the bottle, they're charging more for the mini can than they are for the traditional can. So these are actually more profitable and they attract new attention to consumers. So I think that is very attractive for me as an investor, and Coca-Cola obviously sees this. Now, if you're not in North America, if you're not in the United States and you don't see these every day, if you're in a place like, for example, Romania, they give another opportunity. They usually sell things like the traditional 2-liter Coca-Cola bottle. Now, they're looking at selling new products like the Slink Can Single Serve Pack and the Glass Bottle Single Serve Pack. Now, these newer products like the Slink Can Single Serve and the Glass Bottle Single Serve Pack attract consumers that are in developing and emerging markets, and they have a lot higher revenue growth of 19% compared to the 11 traditional multi-serve pack. These are growing much faster than the traditional 2-liter and other products as well into the developing markets. And this just shows that Coca-Cola, while their legacy Coca-Cola business might be old, they do have a lot of brand recognition and they find ways to even increase revenues a couple percent. Because a company like this is so large, if they're able to bump up profitability 1, 2, 3%, you're looking at billions and billions of dollars worth of cash flows. And this just shows one more example. Have Coca-Cola, not only are they coming out with new products, but their old existing products, like their Coca-Cola brand, is constantly finding new reinventive ways to increase revenues, to adapt to consumer behaviors, and increase profitabilities in all areas of the world, including North America and something like a Romania, for example. But that pretty much wraps up the 5 stocks that I showed for you guys. I own every one of these stocks, and I intend on owning them for a very long time. Some of these companies, I usually refer to them as my lifetime stocks, meaning I'm never going to sell them. And some of those include, like, for example, a Coca-Cola. And all these are 5 companies I'm currently investing in. I stand behind every one of them. It's not financial advice. You guys can do whatever you want. Always do what's best for you. But they're 5 high-yield dividend stocks that I intend on owning for a very long time. And I know I'm going to be very successful from them. And that is what has made me grow my portfolio from $1,500 all the way up to $10,000 and counting, including a new all-time high today as well. So thank you guys so much for watching. I appreciate you watching all the way. And like I said, we've had a lot of referrals. 86 people sign up so far. If you want to get that free $30 for using this brokerage, go ahead and sign up down below. I'd really appreciate it. But thank you guys so much, and I'll catch you guys next time.